So today we shall be looking at small taxpayers, which is our presumptive tax, DT 2009. Precisely, we are looking at turnover as a basis of tax. We are looking at turnover as basis of tax, and we shall be looking at the meaning of presumptive tax, the presumptive tax regime. We shall be looking at the scope of presumptive tax. We shall be looking at some of those fundamentals when it comes to presumptive tax. We shall be looking at the fines and penalties, tax rates under presumptive, and then I will take you through the return submission procedure. If a client comes to you and they want you to file for them the return, what are the steps and what are you supposed to consider? So we shall begin by asking ourselves, who is a small taxpayer? Who is a small taxpayer? So we are saying that a small taxpayer or a small business taxpayer for income tax purposes is a resident taxpayer whose gross turnover from all businesses owned, you see that? Whose gross turnover from all businesses owned by such a person in a year is above 10 million shillings, but less than 150 million shillings. Okay? The gross turnover from all the businesses. So you may find someone has a saloon. They also own a restaurant. They also own a drug shop. Maybe they own a hair and beauty salon. Okay, I've talked about that. A garage, motor vehicle repair. So if we total income coming from all those businesses, and we see that, yes, it is above 10 million, but it is less than 150 million, then that person falls in the category of small taxpayer. And they are going to be taxed under the presumptive tax system or regime. Meaning that we are only going to assess this person for tax on their total sales, which is the turnover. Okay? We are not going to look at expenses as we are going to see ahead, only the turnover. A taxpayer whose gross turnover does not exceed 10 million. If you find that you have a saloon and you don't make more than 10 million in a year, you have a restaurant, you don't make more than 10 million in a year, you have a shop, general merchandise, you don't make more than 10 million in a year, then it means that you have not yet reached the level of paying taxes for your businesses. You do not pay tax on your business income. Okay? So it means that taxation for businesses begins at 10 million. That is what essentially it would mean, that you start to pay taxes if you exceed 10 million in turnover, okay, in gross turnover. So what are the examples of small taxpayers if you are looking out for clients, okay, to serve in this category? Who am I going to look out for? So here, we are looking at people in hair and beauty salons. We are looking at people in general merchandise or general trade. Okay. We are looking at those in restaurant, food provision, bars. We are looking at those running a garage, motor vehicle repair. We are looking at people in drug shops or running drug shops, clinics. Some people refer to this as medical center or medical center, clinic. We are looking at those in carpentry, those in metal workshops, those running metal workshops. Now, it doesn't mean that someone running a saloon is typically or outrightly a small taxpayer. There are huge saloons that make more than 150 million. So you need to do some kind of assessment, as I'm going to show you. What are you going to look at to confirm that this is a small taxpayer? Then there are those clients who are going to come to you, and for them, they have labeled themselves small taxpayers. Someone is running maybe a metal workshop and is really convinced he's a small taxpayer. But when you look at their records, they are actually not small taxpayers, they are large taxpayers. So the issue of small, large taxpayer will depend on the turnover you have made for that particular year, okay? For that particular year under assessment. Next, we talk about the scope of presumptive tax, the scope of presumptive tax. Now, it doesn't mean that I have a business, I'm a small taxpayer because I'm not making more than 150. Presumptive tax has a scope. Now, on the screen, we are saying that a taxpayer for this purpose may be an individual, it can be a trust, or it can actually be a company. Okay? So it doesn't mean that small taxpayer are individuals. No, it can be individual, non-individual. However, this tax system or regime excludes a resident taxpayer who is in the business of providing medical, dental, architectural, engineering, legal, accounting, taxation, entertainment, public utility, construction services. So if you have clients running these, they are not covered by presumptive tax. Some people in construction are convinced that they are small taxpayers, and maybe someone has told them, for you, your business, since you're an individual, you're just doing construction, small construction, you're a small taxpayer. These are the rates, and they actually know the rates, not knowing that presumptive tax does not cover them. We believe that someone running this professional business, like a lawyer, the accountant, someone who is running dental, you are so professional enough to be able to determine your profitability. Presumptive tax was introduced to ease compliance, especially that which comes with preparation of financial statements. People running general merchandise, drug shops, clinics, saloons, they really cannot afford the services of a bookkeeper or services of an auditor or accountant. So to ease compliance, presumptive tax was introduced. But there are sections of business people that we believe, by the nature of their structuring of the company or the business, they can actually afford services of a bookkeeper, services of the accountant. So these are not covered by presumptive tax. In addition, non-resident taxpayers are equally not covered by the presumptive tax regime. They are not covered. So non-residents, we are now, of course, experts. We can determine who is resident, who is non-resident. I believe so, because we have gone through that session. How do we tell someone is resident, someone is non-resident? So that is the scope. And then next, the question is, yes, I have my saloon. I'm a small taxpayer, but I have intentions of expanding my saloon. I want to organize my business so that I am, recognized as a large taxpayer. So can I change the basis of taxation? Okay. We are asking, can a small taxpayer change from presumptive tax? Yes, it is true that presumptive taxpayers can actually seek to be assessed on profits instead of total sales. However, for this to happen, the taxpayer must apply in writing to the Commissioner of Domestic Taxes with specific reasons why, with their small earnings, they want to be assessed on profits. In that application, this small taxpayer must convince the commissioner that they are going to be in position to hire a bookkeeper to be able to help them prepare the financial statements. Because large taxpayers or those outside the scope of presumptive tax are expected to prepare financial statements from which their return can be filed. So that provision is available if your client does. Some people, by the way, naturally, they don't want to be referred to as small. Naturally, they don't want to be referred to as small. So if you don't want to be referred to as small taxpayer, you want to be to hang out with the big boys, the light taxpayers, it is okay. Go ahead, write to the commissioner so that they know that yes, your turnover is still small, but you want to be assessed as a light taxpayer. All right. Next are tax credits and offsets. We know that from the list I've been able to give you, we know that these categories of business people actually deal with professional organizations. Like I know of restaurants, I know of general trade businesses that actually offer services to organizations like banks, like ministries, or government agencies. Now, in those circumstances, there is no way you can, offer services to an NGO, an organized NGO, and you don't, suffer that withholding tax. We are going to be talking about withholding tax in our next segment of the training. So these guys, when you, for instance, if it is a restaurant, a small restaurant offering food to a bank, upon payment, the bank will withhold 6% from that restaurant. So how do we deal with that? Because you're withholding from a small taxpayer. So when it comes to such cases, we are saying that a presumptive taxpayer will be able to offset from their liability any tax that has been withheld at source. However, the presumptive tax is the final tax. It is final, and no tax credit is allowed to offset another tax liability in URA. So, have you experienced a deduction as you are conducting business? If the answer is yes, get the details. What are the details? How much was withheld? So that can be offset. Again, what I don't encourage small taxpayers to do is the provisioning. Okay? The provisioning. Yes, it is okay. You can do provisioning or you can file a provisional tax. We're going to be talking about provisional tax. If you're a small taxpayer, you can go ahead and do that. But you must follow all the rules of provisioning tax. So if provisioning has been done, you did some provisional tax, paid during the year, you can also offset the amount that was paid as provisional tax during the year of income. Next are the expenditures and losses. I'm running my salon, I'm running my clinic, I'm running my carpentry, metal workshop. Of course, I pay expenses such as water. I may pay expenses like electricity. Maybe I'm paying someone to provide security. I have an assistant in my saloon. I'm paying them a salary. How do we deal with these expenditures and losses? So we are asking a question here. Are expenses incurred by small taxpayers deductible? The answer is absolutely no. No deductions are allowed in respect of any expenditure or losses you have incurred during the year of income. So this becomes the disadvantage of filing returns under presumptive. You pay taxes even when you make losses. You pay taxes even when you make losses. And the reason is simple. It's because you are assessed on turnover rather than on profit. URA is looking at the profit rather than the turnover. So that one, you must be clear with your clients that yes, you have incurred expenses, but these expenses are not going to be included in the assessment for tax. All right, now we move into the tax return submission. How do I file? I'm running my saloon. How do I file the returns? Is the process very complicated? Do I need an expert, or I can do it myself? You can do it yourself. That's true. And when it comes to tax returns by small taxpayers, a small taxpayer or small taxpayers are required to submit final income tax returns, the DT 2009. Let me just change this one a bit. Okay. DT 2009 for each year of income is supposed to be filed by the small taxpayers for each year of income, not later than the 6th month after the end of the year of income. So, just like the other taxpayers that we have looked at or that we're going to look at, small taxpayers are also given that allowance of 6 months, put their books together, invite maybe a bookkeeper to look at them, and then they go ahead and they file the return. However, you should note, friends, that for periods after 1st of July 2015, it became mandatory for all small taxpayers to register a payment rather than submit DT 2009. You see that? For periods after 1st of July 2015, of course, we are after that, presumptive taxpayers are required to register a payment for income tax small business. The captured payment details will be considered as your return. So this is, I think it's a brilliant, move by the tax body. It is to their advantage. They are managing cash flow, managing payments. So rather than submitting a return and then you wait maybe for a week as you're collecting the money, you're supposed to register a payment. So as you're filing the return, you are registering your payment and you have to make the payment there and then. Otherwise, your PRN will expire and you need to do it again. So, what are the accounting books and records? Now, for the clients that you're going to work on, ensure that they keep proper, at least the minimum, the proper books of accounts. Why? Because the presumptive taxpayers with proper records pay a lower tax compared to those without records. So this means that you can actually pay presumptive tax on just, guesswork. You can say, I think I made about 80 million. It's okay. You can do that. You can file using 80 million because there is a provision of having records and not having records. That provision is there. But of course, in compliance with the Tax Procedures Code Act, I think I'll be sharing details of the act, the latest one. Small taxpayers are expected to maintain accounting records. Any taxpayer, not only small taxpayers, but all taxpayers are required. It is by law. If you're to run business, if you want to be, you know, free in the country doing business without any interruption, you must keep records. It is in the law. Now, for the small taxpayers, what you do, help them. Help them maintain at least the sales day book. This one will prove um, records or their invoices, okay, to keep the records of invoices sent to the customers and prove their sales on credit. So a sales day book, you don't need a complicated one. Don't need a complicated one. Most of the small taxpayers I see, they maintain this, blue book. You just get a meter rule, put the lines, and then show the date, the invoice you sent to you may talk about small taxpayers not issuing invoices. They do issue invoices. As I've mentioned, you could have a client who wants, to pay using an invoice, like a bank, if you're a salon, I don't know, if you're a restaurant, for instance, and you want to offer services to maybe an NGO, they will need your invoice, okay, before they process that payment. So help them maintain the sales day book. Here they are going to record invoices they have sent to their customers. Then we have a sales returns day book in case we have customers who return back their goods. Yeah, you need to prove that yes, I made this sale, but there was a return. So in this one, you record the credit notes issued for goods that have been returned. Then, as of course your business is growing, later you may need to show history of your expenses if you get out of the bracket of small taxpayer. So it is important that as you maintain the sales day book or the sales, you also maintain the purchases that you make. So you can also maintain the purchases day book, which is a record of the purchases made on credit. And of course, you can also record the expenses, the water, electricity, repairs, maintenance, salaries, everything can be put in the sales day book. Then the cash book, again, a blue book showing the records of cash-based sales. There are people who are going to come and they are going to pay cash. So at least have that blue book to show the daily sales or those who pay against an invoice. You can also record those payments in the cash book. Then also the bank statements. At one point, they might be needed as proof, okay, of the business sales. Mobile money statements are also needed. So if you're using a number, you can stick to one number where people send the money, and then you can be able to extract that. So these are some of the accounting books and records that you should ensure your client at least maintains at their business. Fines and penalties. Do small taxpayers pay fines and penalties? Yes, of course. So here we go into the fines and penalties. A person who fails to file a return by the due date is penalized. A return is said to be late if it is filed after the due date. The penal tax is computed as the greater of 2% of the tax assessed, or 10 currency points, which is about 200,000 per month for the period the return has been outstanding. So these small taxpayers think that for them, these fines don't actually apply to their businesses, which is totally wrong. The fines are there. You pay fines just like any other normal taxpayer. We have seen one here, which is 200,000 if you delay to file the return. The due date is known, so you cannot bypass it and then have excuses. You'll you'll have to pay penal tax. All right, we are going to go into now the practical session. We are going to handle Miss Kweyu. I'm going to show you the different steps. I'll take you to the URA portal, different fields you're going to fill when you're registering the payment, as we have seen. But before you go there, I'm going to challenge you to calculate. I'll give you 5 minutes, read through the question. Then I'm going to share with you the rates. Then we calculate together. So in 5 minutes, you can read through this question, and then we calculate the tax together.